Hey, welcome to the Guaranteed Retirement Guy Show. So today I'm going to answer a question. What is a tax-free retirement account, or what we know as a TFRA? So TFRAs, or tax-free retirement accounts, are just that. They're accounts that give you tax-free income at retirement. And that retirement can be at any age you choose, because these accounts are not restricted like an IRA or 401k, where they say, hey, you can't take your money out until you're 59 and a half, or you're going to incur a 10% penalty from the IRS. With these type of accounts, you can put as much money as you want into them, and you can take that money out in the form of loans for the rest of your life. And typically, people will fund these accounts with a large amount of premium. So you don't have to, but I would recommend, if you're looking at investing in a TFRA, I would say at least $500 a month is where you want to start. You can start a little bit lower if you need to, but it's going to hinder you later on when you want to dump more money into it, meaning you're going to have to restructure, or you're going to have to set up a completely new one. So I'm going to share with you how this works, but before I do, and I'm going to talk about numbers, I'm going to show you exactly what kind of income that you can expect. But before I do this, I just want to explain real quick. It's basically what it is it's an insurance policy. It's a life insurance policy. And you are leveraging the rules and laws of life insurance to create this. So typically you do it with an IUL, although you can do it with a whole life policy. I like IULs, which stand for Index Universal Life, just because it's tied to an index. The average growth is usually a lot higher than a whole life policy, which is usually paying a lot lower dividends. So, but there's risks involved. Obviously, the IULs are just showing illustrated rates based off of hypotheticals, and they should perform that way. But at the same time, it's not absolutely guaranteed like a whole life. But on the flip side, with the guarantees that a whole life will give you, the income is just not very high. And over the long term, you're better off using an IUL. So I'm going to share my screen, and I want to show you how this works. All right. So what I'm looking at here is a policy, and I'm just used my age. I am 42 right now, but I will be 43 in December. So I actually am closer to 43 than I am 42, which means life insurance companies like to use the age that you're closest to. I'm going to increase the death benefit for 15 years. The reason why I do that is because I want to be able to stuff as much money as I can into this account. Okay. So by increasing it over that time period, it allows you to do that. You'll notice I have a box checked up here, minimum death benefit, maximum cash value. And I also have maximum face amount reduction, which applies after the 15 years. This means that I'm telling the software that I want to push as much money as I can into this IUL policy. I want to maximize the cash value, but I also want to minimize the death benefit, because if the death benefit's too high in relation to what I'm putting into it, then it's going to eat up my earnings, which is then going to eat up my future tax-free income. Okay. So it's important that these are structured right. When you structure them right, you can have a lot of growth and a lot of tax-free income later. If you have the death benefit too high, then what's going to happen is it's just going to eat into your cash value. It's going to eat into your future wealth, and it's not going to be good for you. It'll be good for the insurance agent who's selling it, because they're going to get a big commission, but it's not going to be good for you. Okay. So now I'm going to show you a huge scenario, and then I'm going to kind of tailor it down, because most people don't want to do $10,000 a month. Okay. So I put this in here as $10,000 a month, and I did it for 23 years. Okay. Then at the end of the 23 years, on the 24th year, I'm going to start taking income, and I'm going to start taking it in the form of a loan against the death benefit. And of course, I never have to pay that back. That only gets paid back when I pass away. So, and then at that point, the insurance company just settles the account. They pay back the difference, and then they pay out the beneficiaries whatever is left. Okay. So I'm going to show you kind of what this would look like for me. And keep in mind, I do not put $10,000 a month into mine. I actually started mine 20 years ago, and it was a lot less than that. All right. So, but here's what you could do, and people do a lot more than this as well. So you see the MEC premium level up here. I want to point this out because MEC stands for Modified Endowment Contract. And what that means is that's the IRS limit on what you can put into this policy in any given 12-month period. Okay. So that's important to know because if you put more money than that into it in any 12-month period, it's going to become a MEC policy, which means it's all taxable at that point. So the IRS came out with this rule a few decades ago because people were putting super low death benefits and they were putting millions of dollars into these. And the IRS put a stop to it and said, hey, if you're going to put all this money into it, you have to have a death benefit that makes sense. But at the same time, you can still have it much lower than what your premium will actually buy. So if you look here, you'll notice that I am putting in $10,000 a month or $120,000 a year. Okay, accumulation value is $100,000 in the first year. Surrender value is only $23,000. It just takes a while for the surrender value to catch up with the accumulated value. But eventually, after 10 years, they match exactly. And it's just the insurance company is recouping their costs. You have to remember, this is tied to an index. So the index rises, you make money. If the index goes down, you lose nothing. But the insurance company is spending money on options, okay? They are following an index, and that costs money depending on the volatility of the market. And so they're doing this so that you can have maximum growth, but at the same time be protected. So they do have costs. But they also allow your account to grow unhindered, and that's why you see the accumulation value starts out pretty high in the beginning. And so you notice that there is, 100,000 versus 120 that was put in there. That's because there's a cost of insurance. And in relation to $10,000 a month, your death benefit is relatively low at $3.7 million. I mean, that might seem high to some, but most people don't put $10,000 a month into a life insurance policy either. So looking at this, you'll notice that accumulated value continues to grow unhindered. Okay, and you notice the surrender value will catch up to it, and after 10 years, they match exactly. After 10 years, they're both about 1.45. Now, here's the thing to remember for this time period. You are able to take loans against your TFRA. So if you want to take a loan and you want to put it into a secondary investment, you can do that. So if I decided to take out $1.4 million, I don't have to wait 10 years. I could, let's say in the fifth year, I decided to take out, $490,000 and I want to put it into an investment that's making me 15%. Maybe I want to do a hard money loan. Okay. So I can put that in there and it's making me 15%. The cost of my loan, since interest rates are high right now, is around 5%. So I'm netting 10% on that money being out invested in a secondary investment, which is not bad. But keep in mind, this is a loan against the collateral of the account, which means your account is still worth $1.4 million and it's still earning whatever interest. And so if the index happens to go up 10%, your account is going to be credited $140,000. Okay. It does not matter if there is a loan out against it. Okay. It's still going to be earning that money. And so you might wait a few years to pay back that loan. That's okay. That account is going to continue to earn interest. It's going to continue to grow like you never took a loan out because it's a loan. It's not a withdrawal. Therefore, it continues to grow unhindered. Unlike a 401k, you take out a loan, it reduces the amount that's actually working for you. Whereas this, you take out a loan, you're taking a loan directly from the insurance company. Pretty awesome. So you take a loan from the insurance company, they charge you a rate that's usually lower than what your bank would charge you, and then you can put in other investments. You don't have to invest it. I would just recommend it. I mean, you can use the money for anything. You want to pay for a kid's wedding, you want to pay for a new car, just be your own banker. This is kind of the infinite banking concept. If you want to do that, you can do that. But the goal is a lifetime, or really what we want is tax-free income at retirement. And so what I would recommend is as this grows and as you use that money for other secondary investments, just pay it back. Pay it back. And if you want to stuff more money in there, especially from the interest that you're earning from other investments, that'll just make this compound faster. So having said that, you'll notice after 23 years, on the 24th year, I can now take $323,000 a year tax-free for the rest of my life. And so you notice I take that and I keep taking it. And you notice by the time I reach 95, I've taken out this money for so long. I've taken out millions and millions and millions of dollars tax-free. And what happens is I die. And when I die, the insurance company pays all this back, plus the accumulated interest on the loans, because it's a loan, and they subtract it from the death benefit, which at this point, when they do that, my beneficiaries get about $1.2 million. which is not bad. But again, they would get a lot more if I didn't take loans, but I'm doing this for my retirement. So it's for me. But at the same time, your beneficiaries will get what's left after that's paid back. So that is typically how a TFRA will work. When it's structured right, okay, you have a low death benefit and you have it's structured right as far as the death benefit being low, but also increasing at the same time so you can fit more money in there, then that's going to allow you to grow your wealth substantially. And we've got people that are doing millions of dollars into these. And then, of course, we've got people that are doing, $500, $1,000 a month. And so before I end this video, I'm going to show you that because most people can't do $10,000 a month. Okay, so let's get realistic for most of the population that, maybe you're putting money into a 401k and you're thinking, you know what, I don't want to have stock market risk, but I do want to have growth and tax-free income would be great. What can I do, John? Well, here's what you can do. So we'll just keep everything the same and I'll just put $500 a month. Okay. But I don't want to do it I don't want to do it for 23 years. I want to raise that over time because hopefully you'll get raises. You'll make more money. You'll be able to put more money into this. You really want to. So I'm going to do that for 5 years. And I'm going to add a row here. And we're just going to raise that a little bit. Okay. We're going to raise that to $800. So let's say in 5 years, I should be able to, do another $300 into this. I would recommend a lot more, but this is just for an example. All right. So we'll just put this for the $500 a month. Actually, I'm going to change that. I'm going to put that 1 to 3 years. And then 4 to 6 years for $800 a month. And then what I'm going to do is I'm going to add another row and I'm going to put in $1,000 a month. And I'm going to do that from years 7 through 12. And then after that, I'm going to ratchet up to around $1,500 and I'll just leave it there. So this is something you can set up and I can set up for you. You're not tied to these amounts. So if for some reason life changes and you're not making as much as you were hoping, you don't have to do this. This is not contractual, but we're structuring it in a way where you don't shoot yourself in the foot later on, wishing that you would have set it up for more. And now your MEC limit is way low and you can't put more money into it. All right. So 13 through 23. So, the remainder of the policy, you're paying in $1,500 a month or $18,000 a year. Okay. So this might be a little bit more realistic. These numbers don't have to be exactly for you, but we can switch those around. But I just wanted to see maybe something that's a little bit more affordable for some people. And again, we can customize this for you as well. All right. So let's see what that looks like. Again, I'm going to take income in 24 years. So I haven't changed anything. The only thing I've changed is I've structured lower contributions, which means a lower death benefit. You notice the lower death benefit here is now $400,000 instead of $3.7 million. You'll notice that the MEC premium limit is $27,340. Okay, so that's the most you can put in any 12-month period. So you'll notice that if you have like $20,000 during the first few years, you want to just drop it in, you can. As long as you stay under that limit, you'll be fine, and you can really catapult this policy and compound the earnings that are inside of it. Okay, so obviously all the numbers are smaller, but it gives you an idea. So at this point, you've grown it, and again, we've only done this for 23 years. If you can do it much longer, that's going to help you. But 23 years, $463,000 looks like what the value would be, and then at that point, you can take around $32,310 in tax-free income. Keep in mind that they're basing this off of this policy just earning the average of the index, so it's earning enough growth to pay for the cost of insurance, but also pay for the cost of the loans for the rest of your life. You have to structure it right so that the policy won't lapse, okay? And so over time, of course, I can take out, and I'm still taking out quite a bit of money. And by the time I hit 95, they basically subtract everything. If I pass away at 95, they're going to subtract everything plus interest accrued and pay my family around $127,000 after paying everything back. So that's how that works. So you've got your 401k, you've got your IRA, you've got all your other accounts, and they're probably tax deferred. Maybe you have a Roth and you've got a tax-free account that way. But still, it's probably subject to market risk. With a TFRA, a tax-free retirement account where you're leveraging the rules and laws of a life insurance contract, you can tie that to an index, you can have growth, and you can protect yourself 100% from the market. And that is why so many people are doing this. That's why Very, very wealthy people are doing this. John F. Kennedy had one. GE provides this for all their top executives. John McCain had one. Walt Disney had one. J.C. Penney had one. Okay. People who are very, very wealthy or who want to be wealthy will invest in a TFRA because they don't have restrictions. They can retire whenever they want. If you want to start this in your 20s or 30s, and you want to retire in your 50s or 40s, you can do that. Okay, maybe you're just someone who's later in life, you're 40 or 50, maybe even you're close to 60 and you want to fund one of these, you can do that. You just want to put at least 15 years into this. If it's less than 15, I wouldn't recommend it just because you really want enough time for this to compound enough to give you a decent amount of income for the rest of your life. So if this makes sense, if this is something you want me to go over for you personally, just book a call. There's a link below where you can either watch a video or you can go straight to my calendar and book a call with me right there. But I'm happy to go over with you. Yeah, definitely let me know what questions you have, write them down. But if this is something that you're seriously thinking about and that you actually want to leverage for yourself, it might make sense to book a call with me. All right, that's enough for today. Thanks for watching, and we'll see you in the next video.